Global equities rose modestly in March by 0.5%, leaving them higher by just over 1% year to date. European bonds gained 1.3% in the month for gains of 5.8% in 2014. Reassurance from the US Fed that interest rates would not rise as quickly as had been feared after comments made at its mid-March meeting. Hopes for further policy actions from the ECB, an improvement in US economic data following earlier weather-related weakness, and easing of fears over the possible escalation of tensions in Ukraine all contributed to the better markets. At the March Fed meeting, Fed Chairperson Janet Yellen suggested US interest rates could rise around March 2015, causing equities and bonds to sell off. It was thought there was an element of miscommunication in her comments, as the overall tone of the Fed statement and commentary around the meeting was quite dovish. In a later speech, she tempered these concerns when saying that accommodative policy is still required for some time in the US, given the slack that remains in the labour market. The subsequent release of the Fed minutes also revealed that participants were concerned that changes to median forecasts of rate changes overstated policy intentions with respect to the timing of rate rises and could be misconstrued as a move to a less accommodative policy stance. With the minutes indicating that the Fed was not moving towards an early rise in rates, expectations for the first rate rise were pushed back to the second half of 2015, and both equities and bonds rallied on clarification of the Fed's intentions. The market had begun to doubt the ECB's commitment to further easing, but at the April meeting it said it was resolute in its determination to maintain a high degree of monetary accommodation, driven by the fall in Eurozone inflation to 0.5%. The ECB said that there had been unanimous agreement among members to use unconventional measures within its mandate, and that QE or asset purchases had been one of the policy options discussed at the meeting. While not outlining details of what any QE programme would consist of, it gave the impression of a preference for purchases of private over sovereign or public bonds. This seems due to the fact that Europe is more of a bank-based economy than the US, where purchases of government bonds quickly flow through to the pricing of all assets and the overall economy. Instead, in Europe, purchases of private bonds are likely to have a more direct impact on rates, activity and lending than purchases of sovereign bonds. However, the lack of adequate infrastructure and size in European private sector bonds limits the impact of asset purchases in this area, and so an imminent introduction of QE in Europe appears unlikely, with additional work needed to increase the size and liquidity of the private sector before QE could be effectively implemented in this area. An expected higher inflation reading for April could also ease pressure on the ECB for an early activation of QE, and the market may have over-discounted the chances of a European QE programme in coming months. With central banks committed to remaining accommodative, economic and business cycles seem set to last for some time and are likely to continue improving. With low inflation and slack still evident in economies, normalisation of monetary policies is still some way off. With this backdrop, equity markets can continue to move higher, given that they are attractively valued for this stage of the cycle and are particularly attractive against other asset classes such as bonds. With regards to European sovereign bonds, however, from current levels, we would expect negative returns over the remainder of 2014 as yields rise with economic recovery continuing. We believe the beginning of European QE is less likely in the short run than the market currently appears to be anticipating, while there is a possibility that any QE programme, if implemented, could be focused on private sector rather than public sector or sovereign debt, which could contribute to higher yields over the remainder of the year.